started. Thank you everyone for joining us today. My name is Andrea Armeni. I am the Executive Director of Transform Finance and the convener of the Transform Finance Investor Network. On today's webinar, we'll be covering the issue of muni bonds and social justice from the perspective of what investors can do and what are some of the options at their disposal. I'll do a very brief introduction because I don't want to take away any time from the main presentations that we'll have today from Paul Herman from HIP Investor and Mary Taft McPhee and Rodrigo Davis from Neighborly. So for those that joined us in the previous webinar, you might remember this is part 2. During part 1, we started looking at the intersection of racial justice and municipal finance with activists, during which we explored some of the issues that come up in the way in which communities and municipalities in that specific case finance themselves, the way that their revenue comes in particular looking at the issue of revenue derived from fines, incarceration, and the like, and then diving into what the municipal finance might look and what some of the opportunities are to drive better outcomes in terms of the standards for municipalities. As a very brief reminder on the landscape for municipal bond finance, from the impact investor perspective, while everybody has an allocation to fixed income and specifically by and large to muni bonds, only about 6% of total assets under management of impact investors are in public debt. And to the extent that there is, as Paul will go into later, those have largely gone towards green bonds to the extent that there has been an attempt to align the fixed income piece of a portfolio with an impact strategy. But it's also clear that there is quite a well-defined thesis for how municipal finance should play into an impact portfolio, the role that it can play, and the need for communities to be capitalized, especially if we're looking at this from a perspective of social justice and, of course, of racial justice. So we're trying here with these 2 parts of the webinar to really see what is there that investors can do concretely to move more actively on the impact side of their fixed income. One thing that we want to look into is, in Paul's parlance, looking a little bit beyond just the metrics for some of these bonds and how we can increase the accountability that there is on the part of municipalities with their bond issuances. So what role, again, can investors in their choices of what bonds to purchase, what can they do in order to ensure that the municipalities are accountable to the investors that pick them with a specific impact thesis in mind. We'll also look with Mary from Neighborly at the intersection of municipal finance and impact investing with the Community Reinvestment Act. Again, that's something that we have covered in part previously under the rubric of investing for quality jobs versus just a simpler thesis of job creation in low to moderate income zip codes. And for the Investor Network members, I would encourage you to go back to that part after Mary's presentation to see how our work continues to intersect with the Community Reinvestment Act. And lastly, for the members on the call, I wanted to remind you that this work that we're doing around municipal finance is part of a broader project around racial justice and how issues of race come up in a portfolio across all asset classes. We're looking at the public equity piece that is perhaps more often looked at least in terms of the representation of people of color on boards and in top management, but also looking at how racial justice might show up in those public equities, say in terms of decapitalization of communities that comes from tax avoidance strategies by public companies or excessive share buybacks. We're looking at the venture capital, real assets, of course, private equity playing a very big role here. And as part of the role that you can play in this, we would love to hear from you around what would be helpful for an investor that is aligned with racial justice values to know as you are constructing your portfolio. And what are some concrete steps that could be taken? What are the opportunities that show up there? So again, let's keep this broader context in mind as we think today through the intersection of social justice and municipal bond finance. And one way in which we can look at this, again, Paul will be talking to us about the work that HIP Investor has been doing around data and the ratings of muni bonds. And Neighborly will be digging a little bit deeper into the platform that they have created that includes this democratizing element for people in community to be able to finance the projects and the communities that they are particularly interested in. So with that, I will turn it over to Paul, Paul Herman, who is the CEO of HIP Investor. And Paul, I am delighted that you were able to join us today.
Thank you, Andrea, and delighted to be here and join with Transform Finance and Neighborly, and welcome everybody. And as you can see, I like blue shirts, wearing one today as well as in the photo. My background includes working at McKinsey, hence my blue shirt, as well as at Ashoka, supporting social entrepreneurs, at Omidyar Network in investing as well as donating, and for the past 10 plus years now at HIP Investor. Also on the line are teammates from HIP who you may know, Danielle Salah, who leads our Muni ratings, David Sugar, one of our impact analysts, Fabian Wilskett, who heads our corporate ratings, and other teammates. So we're really delighted to have this opportunity to dig deeper into how to do impact investing in muni bonds. So welcome, and in talking about social and environmental justice, there's a high opportunity to create more inclusion and accountability around that inclusion, as well as to create human, social, and environmental justice through your investing in muni bonds. Just a quick overview on HIP. We're going into our 11th year. We started in 2006. Some of you may have seen us in Fast Company magazine and our initial HIP scorecard. Today we have more than 32,000 impact ratings that cover 6,000 corporates and 26,000 plus munis. So we'll show you some scatter plots of all of those muni issuers in different sectors that are facilitating social, racial, and environmental justice. Our clients are endowments and foundations, as well as families, fund managers, hedge funds, and advisors. And the HIP Investor book, which we wrote back in 2010 and published by Wiley, is in 26 universities, MBA and MPA programs. And we've been part of the Newsweek Green Rankings and ratings environmental impacts of the top 1,000 companies. We've been fortunate to be covered in the media. And then just a quick disclaimer, so all the compliance and lawyers are happy, and always remember past results are not indicative of future performance, so always look forward. So the value and benefit of any impact rating are these three, and as you present to your boards or talk to your executive team or to your family group, these are the three things that impact can deliver and impact ratings can inform. You get to analyze more risks. Risks over the long term. In muni bonds specifically, the credit ratings from S&P, Moody's, and Fitch frequently look only at the next 2 to 3 years of cash flow, not at the total risks of the full life cycle of the bond. 2, better understanding the drivers of cash flow. While not all munis even provide a minimum level of financial analysis, for example, in the state of Kentucky, they don't even provide annual financial statements if you invest in state bonds necessarily. Cash flow is driven by how you serve citizens, customers, and beneficiaries. And we'll talk a little bit more about that in the presentation. And what it does do is help to smooth out volatility by looking at some of these risks. And then, importantly, 3 of the ABC is you can customize the portfolio to your own impact goals. And these can include, obviously, social, environmental, and human impact. So as Andrea introduced, muni bonds are a large component of portfolios, and an increasing part of muni bonds are impact-oriented. The growth is mainly driven on the equity side to date, both public equity and private equity. But you'll hear from Neighborly the increasing growth on the muni bond side. And as a whole of professional assets managed, impact investing, ESG investing, socially responsible investing is more than $1 in $5. And the growth of green bonds recently has doubled from 2015 to 2016 to $80 billion. And what that means is it's almost 2% of the overall muni bond market. So there's still room for growth, certainly environmentally, and we're going to talk about some opportunities in social justice. And as we describe this, what we're trying to do is to set a high bar for social justice that we would think of on a 0 to 100 scale, being closer to 100. And on a 0 to 100 scale, if you look at everything from how urban hospitals serve low-income patients to low-income kids and school kids on free school lunches in K-12, as well as the availability of renewable power and clean power. Those all have a net positive impact. And what we have found over the 10-plus years at HIP is that generally correlates with lower future risk, so a more resilient portfolio, and stronger potential return. So what we're going to dig into is how to innovate by people with nature in across 5 different categories: health, wealth, earth, equality, and trust. So are based on Maslow's hierarchy of needs and hopefully line up with one or more of the missions and themes that you're pursuing in your own portfolio. And what we found on the corporate side, both on the corporate equity and the supports it on the corporate bond side, and what's emerging on the muni bond side, is that higher impact ratings connect with higher cash flow, and both higher cash flow and lower volatility of cash flow. And lower ratings and certainly lower transparency about how you operate and deliver impact could hamper cash flow or even link with negative cash flow. So in the muni markets, there have been some defaults in the cities and counties in the U.S., and we took a time machine and went back in time to say, well, what would their impact rating have been at that point in time when they, in the early 2000s or mid-2000s? And could this have been an early indicator of some of the risks? And so in Jefferson County, Alabama, and Harrisburg, Pennsylvania, and San Bernardino, California, and Stockton, California, these cities ended up not delivering great services to their citizens. They were not able to provide great health services. They were not able to generate income opportunities for their citizens. It was difficult to sort of support equality and ethnic justice. And so it turned out that a impact rating also correlated to the weakness in their fundamental cash flow and credit. So what we can look at nationally then is if you look at, from an impact perspective, these elements of health and wealth and earth and equality and trust is, some people said this sometimes lines up with the electoral map, where states in the South and Southeast don't have the best profiles in terms of a healthier, wealthier, environmental conscious, and equal society. And nationally around the world, you can see that also in Africa, this is similar to the UN Human Development Index, but enhanced with additional impact metrics, that there's opportunities in Asia and Africa for enhancement, as well as worldwide. So to dig deep, what we wanted to do was profile some core problems and highlights of where muni bond investing might advance this, and what you'll hear from Neighborly are some tangible ways to invest in your own community and do that on the Neighborly platform. So what we affectionately call now the HIP lollipops here, the impact lollipops of health, wealth, earth, equality, and trust. We're going to go through examples in these first four. So the first segment is hospitals, and when you analyze a hospital, two key things are, one, what are the outcomes of the people who come to that hospital, and what are the patient satisfaction metrics? And through Medicare and Medicaid and other publicly available data, what we've done is to aggregate several thousand hospitals, 4,000 hospitals nationwide, and evaluate these metrics, and we're continually adding metrics to this, but you can see that we're evaluating 11 metrics on each of the 4,000 hospitals nationwide, and that these generally correlate with good patient satisfaction and good health outcomes. Those are weighted most highly. So each of these dots is a hospital nationwide. So we could, in an interactive way, we have an interactive tool where you could look up your own hospital. But for any particular hospital performance, there's still a wide dispersion, both of patient satisfaction and overall impact. So there's no perfect institution. It's a mix of good and bad, and this is what you'll find in any impact, in any solid impact rating, is there'll always be opportunities for improvement, but the question is, how do you deliver on your mission? So what we like to do is to compare through a face-off, compare how hospitals or any impact investment rate against each other and deliver against each other. And so these are two hospitals, Bellevue Hospital Center in New York, which is part of the New York City healthcare system, also serves quite a few mental health patients, certainly serves a fair number of low-income patients. They have very low patient satisfaction scores, only about 1 in 4. The health outcomes from the potential health outcomes is also a low score, 1 in 4, including things like, do you get readmitted after you've been treated, as well as are you treated well, are you, is your health fixed on the first time? And then this is sort of an extreme example, but the number of health and safety violations in the Bellevue Hospital Center over a 5-year period is actually 14. And that is literally almost off the charts. Most hospitals that aren't doing that well max out at about 3 or 4. Most hospitals have 0 or 1, as you can see on the Jewish hospital on the right-hand side, which ironically is part of the Catholic healthcare system. And so those have health outcomes of 3 out of 4 and higher patient satisfaction, not perfect patient satisfaction, still below 50%. So as we wrap this together, we say, well, what's happening in across the country, and do those have adverse incomes in urban areas? And so what was surprising to us when we did this bottom-up analysis of 4,000 hospitals and then looked at the state averages was New York State and California State and Florida State, as well as Nevada, New Mexico, and West Virginia, which have a high proportion of hospitals serving low income, actually have some lagging performance. So this could be an impact investing opportunity to target the hospitals or healthcare systems that aren't yet serving the urban population in a compelling way. And that would be a great way to mobilize dollars among foundations and with missions of healthcare or impact investments that have healthcare as an allocation to dig in deeper. Specifically in the Kaiser system in California, you see a lot of high ratings among many Kaiser hospitals, except in Oakland. So we've looked at this both from a national level as well as from a local level, and happy to dig in deeper at a later time. So we covered health. The second segment is wealth. So when we'll look at women entrepreneurs and ethnic entrepreneurs in cities in a few moments. And there's 19,000 cities across the U.S. There's also 3,000 counties in 50 states, plus D.C. and Puerto Rico. And when we look at a city, you can see the balance of these pillars of health, wealth, earth, equality are equal weighted. To run a city is a very complicated, integrated thing. And to serve citizens takes a lot of discipline, empowerment, and capability. So some of the metrics that we look at are citizens with health insurance, the affordability of housing. We also have a rating system for state housing agencies for the 49 states that have affordable housing agencies. Kansas actually does it through the state, as well as things like women-owned businesses. So from a gender equality and a social justice perspective, when you plot some of the cities according to their incomes, on the x-axis is the average household income in cities across the U.S. The size of the circles, I know these are a little small, but the size of the circles are the population. And what you can see is a general relationship that when cities' household income is lower, the proportion of women-owned businesses and women entrepreneurs is higher. And you can see that far left, Detroit, actually is more than 60% of entrepreneurs in Detroit are women, as well as dots in the top left for Memphis and Baltimore. So to make this a little bit more stark, we've all heard of, or many of us have seen The Wire, and what happens in Baltimore is the suburbs around Baltimore actually are more well off than the actual city of Baltimore. And a group of foundations have focused on starting to hone in on how to solve these problems, but it's possible to work with the city of Baltimore in their muni bond investing to help set some accountability metrics on how you're going to address some of the crime that exists in Baltimore and the health aspects and the like. And you'll hear from Neighborly later on some of these focuses. Interestingly, District of Columbia has a much higher performance, even though it has some areas of District of Columbia that might rate lower. So in social and racial justice, this relationship exists as well, where cities with lower income have higher proportions of businesses and entrepreneurs that are ethnic or minority owned. So up in the top left, again, you can see Detroit, but also a lot of cities in Texas, Laredo, Mission, El Paso. You also see East Palo Alto, which is adjacent to Palo Alto, homes of Facebook and Hewlett-Packard and Stanford University. And so there's dramatic improvement opportunity, which can be linked to muni bonds. So we covered health and wealth. The third sector is earth and environment. And our team here has done a deep dive. Dave Sugar going to Presidio Graduate School, where we find a lot of great talent. Created this from the bottom up. So this is several thousand power plants across the U.S. It actually turns out to be 4,000 power plants across the U.S. that are part of 2,000 utilities. Now, many of us know our local utility, which are generally investor-owned utilities. There's about 150 of those nationwide. So that means there's more than almost 1,800 or more nonprofit or government energy utilities nationwide. And we look at everything not only at power mix and low-carbon power mix, but coal ash spills, because many of these are still running on coal power, and time-based pricing, power reliability. So if you have an environmental focus as part of your investing or foundation or family, this chart might be interesting to you. Now, we all know about coal country in Kentucky and West Virginia and Ohio and Indiana. And some of those voters got quite active in the last election, and they feel left behind. However, in the power mix of Detroit Energy or the utilities in that Midwest, they're generating a tremendous amount of carbon-intensive power. Not only coal, but high-sulfur coal, 3.5% gets burned in some. And companies like Duke Power still, while they talk about clean coal, produce this. Whereas in New England and New York and Maine, and then over in Washington and Idaho, which has a lot of hydropower, as well as Oregon and California, you can see that there's a bigger push, and then a bright spot also here in South Dakota versus North Dakota. North Dakota is the land of some of the tar sands and natural gas fracking. South Dakota has been adding more wind. And you can see that down in Texas, too, where there's a blend. So Boone Pickens has actually been putting in large wind farms there. So what this means for muni bond investing is, and Neighborly have a large segment of this on their platform, is you can go and fund carbon efficient or even fossil free. And when you look at that as a blend of all the different issues, but not just carbon power, but incentive pricing from utilities, you can see some of the states leading, again, Vermont, New England, Idaho, Washington, California, Arizona, being more progressive, and then some, even Oregon, lagging on sort of a broader set of environmental metrics. And what's really exciting now is many of us have probably heard about social impact bonds or pay-for-performance contracts. There's now the first environmental impact bond, or EIB. So sexy acronym, but the environmental impact bond from DC Water is helped facilitated by Goldman Sachs and also by Calvert, the Calvert Foundation and Calvert Mutual Funds. And what they've come up with, which is pretty interesting, is to put some teeth, as we like to call it, on an environmental impact bond. And so every environmental related bond, we talked about earlier, green bonds having $80 billion. They're rated green because they meet some green bond principles. They have an environmental outcome, but they don't necessarily have an environmental target or metric. And none of them, until this one from DC Water, actually have any accountability to that metric. So if we all unify together with our investor power to force and reward or penalize issuers for not only putting down a stake in the ground on women entrepreneur income improvement, service and patient satisfaction and health outcomes to hospitals and low income, and in this case for DC Water, runoff reduction. This was modeled essentially where the 95% confidence level of reducing wastewater overflows from the wastewater treatment plants should go down by about 30%. That means when it rains hard, like it is in some places around the country today, that the wastewater backs up and it overflows and it pollutes the water systems. So in this case, if DC Water delivers between 18 and 41% reductions, then everybody gets what they expect. But if DC falls short of doing that, if they put in this infrastructure and they don't deliver that, in this case the investors are taking the risk, and the investors actually have to kick in some extra money. Whereas if DC Water exceeds the runoff reduction, they'll actually pay investors for the extra savings that DC Water's encountering. Now, this is sort of a uniquely structured incentive. This isn't something that we design in this way. Usually you'd want to have more upside to align incentives for the issuer and the investor to make more money for higher results. So that's something for further discussion later. All right, finally, the fourth sector is around equality and how you can organize your money to support education outcomes and growing our next generation. And what we've analyzed across 13,000 school districts nationally from publicly available information that's in a whole bunch of different hiding places. So it's not easy to do this. It's not easy to aggregate it. It's not easy to quality check it. There's some strange things that happen sometime in collecting data, which can be messy. It always sounds organized, but there's a process to it. Is looking at faculty to student ratios in classrooms and math and reading scores, looking at the district revenue per student, as well as free in school and reduced lunches. And one last thing, because we don't have a chart on this yet, but you see that last one about board and student diversity. And we've done this for investors in looking at specific K-12 school districts of where there are opportunities for the governance of the school district to match the diversity of the student body. And in places like Texas, you end up having sort of white or Caucasian school boards or mainly Hispanic school districts that are not as well performing as some others. But there are a couple interesting exceptions, and one of those is in South Carolina, where there actually is a primarily Caucasian school board. It is more gender diverse, with African American and diverse student body, and it's actually one of the most well performing. So it's not it's not necessarily a bad thing when this doesn't match, but in general, we want the governance to match the student body, the citizens, the beneficiaries. So at HIP, we love charts like this because we're quantitatively oriented and analytically rigorous. So this is all 13,000 school districts that have available data in the U.S. And usually when you think of school districts, you think of, I'm funding positive education for kids, especially low-income kids. And what you see is a very wide dispersion. So the x-axis is the district revenue to the school. So some districts are well off, some districts have lower revenue, And on the y-axis is this overall student performance and district rating. And so you can see a couple quadrants. And so the question for you on the line is, what quadrant is the most investable? What might have the best impact? What can get you the best impact for a dollar of your money? And so on the next slide is we hone in on this top left of the quadrant. And so there's thousands of school districts that have low district revenue per student, but have high district performance, student performance, education outcomes. So this could be a great target for your impact investing is help low revenue school districts deliver even better outcomes. But you might also say, can't we also help low performing outcomes do better? And we could, this could be the case where if you add more capital, you could get higher results. But we'd want to add some form of accountability metric to that and discipline to that, and hence do something like an environmental impact bond or social impact bond. So as you consider voting with your money, wrapping up our introduction here, as you consider voting with your money, muni bonds are one of the highest impact ways that you can deploy your money. And there, to date, haven't been a lot of investment strategies that do this. There are some from community capital management and mutual fund crank. There are some from Calvert in their green bond fund. There are SMA strategies that exist from Breckenridge and others in development. And what you'll find is that those impacts are much stronger than you might have in later stage private equity or your mutual funds, and certainly in your hedge funds. And that early stage venture capital can rate highly, similar to muni bonds. But as you grow, you can see as you scale up an institution, it has been difficult so far to scale institutions that don't become more extractive. That as you move from venture capital to private equity to public corporations, those are more extractive of people, of natural resources, and of trust. But in muni bonds, you actually can scale this. If you actually do have, you're on mission, you can scale up impact at the same time. So as opportunities for action and a transition to neighborly and talking about how that might work in your own portfolio, we recommend these three things. One, if you're not already doing this, and most of us on the call may already be doing this, to update your investment policy statement and IPS for impact goals and metrics. And to put in specific metrics that you might be targeting around social justice, ethnic and racial diversity, and environmental benefits. Two is to add impact-focused munis, either munis themselves or separate account strategies or funds to your diversified portfolios. And they can address a range of themes here, including migrating to the UN Sustainable Development Goals. And then third is to support muni bonds with teeth and to evaluate those and consider buying those. Because the more we can drive the market, like we have been with green bonds, with impact bonds, with ratings attached to accountability, we can actually do more good as well as make more money. So we're going to turn it over, and thanks for your attention. Happy to answer questions as we get to them later, but excited that Mary and Rodrigo are here from Neighborly. Back to you, Andrea.
Thank you so much, Paul. That was fantastic. Really, really helpful, very clear showing of this. Two quick questions, one from the work that we've been doing previously and one that came in through the chat. The first question is very concretely looking at the instance that you brought up of Bellevue versus Jewish Hospital. How would an investor go about it? If I'm understanding you correctly, you're saying, okay, Jewish Hospital will have a lower risk for your investment based on the HIP rating. On the other hand, Bellevue really needs help. So the first question there would be, yeah, how do you even conceptualize that decision?
Yeah, so that's a great question, and this is sort of the dramatic need that exists. It's very, it's very emotional and visceral when you see this. And as we're doing additional research on Bellevue, a lot of the patients are mental health patients, so it's going to be a long-term investment to help them and really take some progressive approaches to evolve how mental health gets delivered. Because even 50 or 100 years ago, you just put mental health people away in an institution with very little support. So the way to conceptualize this is, what is the outcome that we're shooting for? The good news is the patient satisfaction and health outcome data is regularly reported and tracked. And so we have an underlying metric system that's mandated to be reported, let's say in hospitals. And this is what we try and do in all our ratings to make sure that they can be recurring so you can track progress over time. Possibly set a target for patient satisfaction or health outcomes or both for either that hospital or hospital system. It is possible for munis to be issued from a single facility or a subgroup of facilities in a healthcare system. So we've seen that in rating munis over the past 4.5 years. Then in approaching the issuer saying, we think some capital or other expertise can help, so can we set a metric to track on this, and then possibly even to set a reward or penalty for improvements in that, either annual improvements or total cumulative improvements, and then bringing an investor coalition to engage in that way. The muni market is so fragmented today, it's ended up becoming these large pools of money being sold through wholesalers, and there's been a lack of engagement on the muni side. So pinpointing just sort of a small group of hospitals or a city on its women entrepreneurs or a state on its renewable energy can package it in such a way where there's muni bonds for water authorities that group 50 water authorities together. So they're scalable in different sizes, and Neighborly might be able to speak to this too, to help group that investor power, set an accountability metric, engage the issuer, and then, within half a year or a year, that new issuance could come out similar to what we saw with DC Water.
Fantastic, very, very helpful. And so the real mechanism for accountability there would be more in the context of penalizing a future issuance, let's say, rather than being able to act directly on the current issuance.
Well, there may be some influence over the current issuance, but it's really in the secondary market. So if you think that engaging today will improve cash flow with the existing issuer and the price of that bond, then it could be influenced today. Certainly by voting with your dollars today in allocating. So it's probably more of an opportunity today to pick a highly rated but possibly under-resourced, like we saw in that top left quadrant of education, that those look like they have good management discipline and that those are safer bonds to invest in and possibly more reliable and stronger for your portfolio. But to make this transformation from low performing to high performing, you need to ask the question, what's going to change? Either what new management or management discipline or what new accountability metric will come in. So yeah, we'd be excited to have a deeper conversation about this with groups of people who want to structure these and bring an investor coalition to help both reinforce what's working today and how to make these transformational jumps from low performance to high performance.
Terrific. Thank you so much, Paul. And maybe we can use the next question as part of the Neighborly presentation. And that question is, how possible is it to invest in nonprofit hospitals, and what are the mechanisms that one can use to invest in them? So with that, let me turn it over to Mary. Oh, sorry, I need to reclaim that.
Yeah, I'll just jump in one more time. Muni bonds are issued by a variety of issuers. They're issued by governments. That's why we think of them as munis, but they're issued by nonprofits. And in a few cases, they're actually issued by for-profits with government cover. So any organization can issue a muni, and it's a question of whether you might get a tax advantage or not, because there are some whereas most munis are tax-free, some are taxable. Over to the Neighborly team.
Terrific. Thank you so much, Paul. Much appreciated. And for the rest of the participants, please feel free to use the chat function if you would like to ask questions, and then we'll present them to Mary and Rodrigo at the end. Mary from Neighborly, thank you so much for joining us.
Wonderful. Thank you, Andrea, and thank you, Paul, for your presentation. That was great. Let me move forward here. We're going to talk about impact investing in municipal bonds and specifically how the CRA, the Community Reinvestment Act, can be involved in that. We're in the U.S. public finance space. We're highly regulated, and we have a registered broker-dealer called Neighborly Securities, which is a wholly owned subsidiary. We're not a municipal advisor, and none of what I say today should be construed as investment advice. So moving on to the CRA, it's a $200 billion, roughly a $200 billion annually investment opportunity. And the question I want to ask is, is there a way to engage or leverage existing regulations and mandates and help them work better to allocate capital where it's most effective? So the CRA was enacted in 1977 to help repair some of the consequences of historical discrimination and redlining practices. Given the historical context of that, the communities that they're targeting, low and moderate income communities, are basically a proxy for racial justice here. In its simplest form, it requires banks to invest in those communities as part of their portfolio. They're examined approximately every 2 years and receive one of the 4 ratings shown on this slide based on a multi-part test. You can see they are not particularly quantitative. So the first question you might ask is, why do they matter? It's because a low rating both has public relations impacts for these banks, and it's also considered by regulators when they're approving activities like a bank merger or an opening of a new branch. For a large bank, there's a 3-part test. Lending and service are 2 portions we're not going to be discussing at length today, but there is a 25% part of that test that focuses on their investment activities. So you may ask, are municipal bonds CRA qualified? Yes, they absolutely are. The Office of the Controller of the Currency has stated explicitly in their FAQs that especially projects eligible for low-income housing tax credits and bonds that specifically support community development certainly are eligible to receive credit. Innovative projects like hospitals in lower moderate income areas and impact securities also would qualify. I can't advance this. There we go. So another component of this Act is that it suggests that the banks need to examine the performance context of the communities in which they operate. In order to do this really fully, you need to have a lot of information about those communities. And I think part of the reason this Act hasn't functioned as intended is that this is actually really hard information to find. And it's even harder to standardize and evaluate, as Paul mentioned. This is a problem we also face as impact investors. And so a question we might ask is, how do we help banks access this data and actually use it to transform this funding stream into one that actually has impact on their communities? Like I said, they are at the present moment basically ticking the boxes with the minimum level of effort required to meet these obligations. The CRA itself, as written, encourages innovative investments and provides greater credit or greater weighting to those investments. For example, Goldman Sachs has received already CRA investment credit for an impact bond that they issued, and Morgan Stanley received credit for a pretty innovative program that linked local health centers to affordable housing. The idea here is that there's 2 complementary approaches that we can take to help this law serve its actual purpose. One is to work with advocacy organizations in our communities to influence the structure of projects and bond funding so that it's obvious that they fit CRA requirements. And then second is to create a network of investors who are interested in holding these bonds, A, because of their positive impact, and B, because of the additional demand for them to produce additional return. So banks looking to invest in this, and we have a source of CRA eligible investments. We may catch a bid for those that would service us as investors and also help reduce the cost of funding these projects. So I'll talk a little bit more about how to get banks comfortable with stepping out on the more meaningful investment curve. But for now, let's take a simple example of how this works in the wild. In the state of California, for example, there are a number of banks that are evaluated under the CRA. I have here for you everyone that has a market share over 1% in the state. these banks are evaluated on the areas that they serve, and it's the concept of an assessment area. Now that can be very large. For instance, LA County, which includes both very poor and underserved neighborhoods and some huge pockets of privilege. So when you're saying, you know, this bank made an investment in LA County, that could be either meaningful or totally useless in terms of its impact. And so for that purpose, there's this concept in the CRA of what they call a distressed or underserved non-metropolitan middle-income geography. These are more homogeneous rural areas, and so for the sake of simplicity for this example, let's take a look at what those are in the state of California. So 4 banks in those communities, you can see that the largest banks change somewhat. I mentioned that bank exams take place every 2 years on average, and as it turns out, Scott Valley Bank, listed here, has an exam scheduled for the first quarter of 2017. So let's pretend that we are Scott Valley Bank. We can go onto the CRA website and see what our previous ratings are. You'll see it's being evaluated under the intermediate small institution exam, which is slightly different in terms of weighting from the large bank exam, but also includes an investment component. So we as Scott Valley Bank currently have a satisfactory rating, but we're planning, let's say, to acquire a competitor later this year. We want to make sure that we get approval, so we were looking to improve our rating to outstanding. And if we were to go into the municipal market, I'm looking at a data set from the California Debt and Investment Advisory Commission, spanning the decade from 2006 to 2016. It covers a total of 19,000 issues, about 16,000 which are short-term. And so if you were a bank officer looking to do the least effort possible to meet your obligations in this area, you would go in and filter these issuances to see, okay, well, how many in that decade have been issued in these selected counties. You see it's 71. That's because we selected these specifically because they're rural and not large issuers, so that we can make the point, which is that there's really, in those 71 issuances, only one that is, at first glance, a clear match for a CRA-eligible investment. And I perform these filters with a very conservative bias, looking basically for redevelopment agencies, which are often builders of low-income multifamily housing. And so in that time, the one that looks like a fit is actually issued by a redevelopment agency in Mendocino County. And the total size of it is $4.5 million. So that's pretty tough. We still don't know for certain if it is in fact CRA qualified. We need to look into the actual documents to find out. Now I'll pause here to say, you know, when we were doing these filters, I was filtering on purpose among other fields, and there's a lot of stuff that looks like multiple capital improvements or public works in terms of the purpose of a bond. And Paul touched on this earlier. There's many municipal projects bundle specific activities across a region into one issuance because the friction that these issuers experience when they come to market is such that they want to issue the largest size possible when they're doing it to fund all the projects that they have to fund. So it may very well be that in those multi-purpose bonds, there are several projects of great interest to impact investors that, because they're bundled up, can't be accessed and used for these purposes. So one thing to focus on is unbundling municipal bonds where possible, and part of that is democratizing access for issuers and investors in this market. So I mentioned we had to go into the documents. This is the offering document of that bond in particular, and we see here that it is targeted at folks whose adjusted income is less than 50% of the median income for the area. Fortunately, that maps exactly to the requirements for the CRA, which defines low income as less than 50% of the median, and moderate income is between 50 and 80%. There are many cases in which a state financing authority may target a different cut point for what they consider lower or moderate income communities. That's a huge problem, right? We need to make these standardized. We need to make them fit the CRA parameters where possible. And then once we've done it, we need to communicate it so that banks and others can access this information quickly, understand that this is an investable opportunity, and then invest. It's very possible that there are significantly more opportunities out there in this space and in other parts of California with community development financial institutions, hospitals, social impact funds, as I mentioned, that just need to be specified as CRA eligible and highlighted as so. So to step back for a second, what do CRA opportunities look like in the state of California as a whole? Again, using a very conservative filter on this. This is just the year 2016. There were slightly under 3,000 issuances, representing a total of $76 billion in public funds. And looking again just at housing, not all of which is CRA eligible, but it's a good proxy for the size of that market as currently defined. You see it's about 6% of total issuance on that year, or about $4.8 billion. If we, again, staying with our conservative bias, look at only redevelopment agencies in that decade period that have specifically denoted housing only as the purpose of their issuance, we have 112 issuances representing 74 different entities during that time. And what I've plotted here, and I apologize for the illegibility of this plot, is the relationship between the average issuance size and the average cost of issuance for these issuers. And you can see a general trend that smaller deals might cost more, which you might expect they require more special treatment and probably are issued by less sophisticated entities. But there's a lot of variability around this, which to me suggests that there's room for improving outcomes here in terms of cost of issuance. And one way would be making sure that these deals find their target market. So if they are CRA eligible, making that public and easily accessible knowledge. So how might we do this? One path that the Kansas City Fed has provided is this very innovative program that allows banks and community agencies to jointly vet a proposed deal in advance of this issuance in order to make sure that it will receive investment credit.
Can you tell us a little bit more, Mary, about that program and the role that the community would play in that?
Yes, so it would be that a community who identified a need would be find a bank that needs to invest in that community. So let's say they needed more hospitals in that area that targeted folks who were on Medicaid or Medicare. And so they would say, okay, well, here's a proposed site. Can we do this program in an innovative way, maybe with pay-for-performance, maybe with some nonprofit support, and build this issuance that you would be comfortable underwriting, and then possibly banks investing in, and then bring that to the Kansas City Fed in advance and make sure that that would receive credit, right? So it removes the bank's fear that by stepping out on the curve here that they may miss the boat of getting CRA investment credit. So the Kansas City Fed does it in their service area. You can reach out to them to get information about whether an investment might be approved in other areas, but obviously they can't be the definitive word there. So to revisit action items here, we would like to encourage more banks to run programs like this. If you're going to have a regulatory requirement, it should be easy to understand. And when it's not, I think that the role these institutions can serve in clearing banks to move forward with their investments is huge. Like I said, pilot innovative municipal financing that meet the CRA requirements, share these positive outcomes widely. One organization doing this already in California is the California Reinvestment Coalition, which is partnering to make transformative investments in our communities. The next thing is to create metrics that correspond to CRA categories, so making sure that these map directly wherever possible, and as impact investors, advocating that they be disclosed as often as possible when they invest, and to join Neighborly's public finance data community, where we are moving forward and trying to capture these data points, and also helping issuers create innovative issuances. So with that, I'm going to hand it over to Rodrigo, who's our Chief Product Officer, to talk more about the community and our products at Neighborly.
Great. Thanks so much, Mary. Andrea, are you able to hand over slide control to me, please?
Yes, it's coming your way.
Thank you. Yeah, so as Mary said there, the sort of aggregation, collection, access to this data is a really key challenge here. And we're building an open source data platform for public finance and a community around that. And how we're doing that is essentially trying to develop open, transparent data standards that everybody can access and contribute to. So we've collaborated with organizations like OpenGov, CDAC in the California State Treasurer's Office, and also ingested many data sets from national, state, and local level in order to sort of create a platform where folks can access data about municipal finance in a structured way that really helps them in their workflows. And in its sort of simplest form, this takes the form on Neighborly of a profile page for an issuer with a range of relevant metrics, and then a page for each individual issuance. So it's a very large kind of web of information. And the collection of that data is pretty complex. Of course, there's a lot of dependencies, a lot of updating to do, and a lot of infrastructure. But we believe putting in that groundwork is absolutely key to unlocking this market and making it more useful. And then, of course, once you've built that foundation, on top of it, there's potential to build all kinds of comparison analysis tools, things to help you match to mandates, do spread comparisons, etc. If any of that stuff sounds exciting to you, do reach out to Mary or me. We'd be very happy to chat on that. But the data is also just one sort of step here, and one part of our mission. As Mary mentioned, we are a registered broker-dealer. A key part of our mission is unlocking access to munis for everybody. We really do mean everybody. The sort of capital network that we've put together runs the gamut from individuals down the street all the way up to large global institutions and everything in between. And what we've heard universally from these folks is that they want the flow of information, the flow of capital and public finance to go a lot faster and with much greater transparency. And there's a huge opportunity here, and we see that already from the folks who've come into Neighborly. We haven't sort of marketed this aspect of our business very much at all up to this point. This is all really just organic interest of folks who've heard about us. So when we really start doing more structured outreach, we expect these numbers to grow a lot more. So with that in mind, with a really huge potential and an interesting data foundation, how do we tell the story of these potential investments in this data-rich future? Well, this is an example of a potential project, not a real one in this case, around green bonds in the city of Palo Alto. And what we're doing here is essentially taking the types of information that you might find scattered in many different sources, offering documents, third-party sources, cities' websites, etc., and bringing that all together and saying to the investor, hey, here's the complete story of a green bond. Here's the data that helps you to feel like this investment has not just been labeled green as a kind of a marketing slogan, but there's actually, as Paul put it, some teeth behind this. And being able to link to metrics and to data points is obviously really key here as we build for the future. And for folks who do have existing mandates or who are developing mandates, we also need ways to access the sort of impact data that are structured and can be matched to mandates. And here's an example of how we visualized HIP's impact rating score alongside traditional ratings to create a kind of a pentagram of an impact investment policy. And you see next to it to the right, those are the metrics that are sort of backing this. This is really just one example of how we can get very creative in our product in supporting many different types of mandates, allow folks to share their mandates, match to real data, to real opportunities. So we think the potential here is really massive. So that's a little bit about us, very briefly. Very happy to continue the conversation with you. This is obviously a very active R&D area for us, so we're always excited to have conversations to help you isolate the critical use cases you have for these tools that we're building and figure out ways to work together. On the slide, just a couple of folks who have backed us in the past, And yeah, let's kick it off with some questions.
Fantastic. Thank you so much, Rodrigo. And as he hinted, please feel free to send in questions through the chat. That is the best way of doing it. Or you can also raise your hand through the webinar function. One thing to kick this off, both back to you and to Mary. Mary, I will unmute you for that. This issue of the information being hard to find and being hard to systematize, what has been the general appetite on getting more information? Where are some of the main pain points that you're seeing there?
Mary, do you want to speak to that? Yeah.
Yeah, I will. I think, you know, in municipal bonds, the sort of source of truth for every question is the offering document itself. Which is great if you want to do this on a one-off basis. You can go in there and find almost everything that you would ever want to know about a project and its meaning. You know, whether or not those funds actually go to the stated purpose is something that may need to be audited along the way. But in terms of what is it designated for and who's it serving, very easy to know by reading that document. Unfortunately, these things are, you know, up to 120-page PDFs, and to analyze that in any systematic way is pretty difficult. So one sort of next level future thing would be to have these documents be, you know, coded in XBRL or done in some sort of standard template or format that allows users to query their purpose and use of funds a lot more easily than going through manually each document.
Great, thank you. And one more question. One thing that had excited me about your work is really this idea of democratizing access for individual investors that are interested in providing capital within their communities. Can you tell us a little bit more about what that landscape looks like if I, as an individual, want to invest in a specific muni bond for my town? Versus what would be possible within the Neighborly platform?
Yeah, sure. So this year we're piloting with 7 issuers so far that we've announced, where you'll be able to come onto the Neighborly platform and invest in bonds, in most cases at $1,000 denomination. Which is much below the sort of 5,000 conventional denom in the market. And essentially what we're doing there is partnering with issuers to help them standardize the whole process from front to back. So make offering documents that are easier to read, have a central place where any community member can show up, get a brokerage account very easily, in a short period of time, and then be able to make the investment online without ever needing to leave their computer. So yeah, so that's kind of our starting point. The one challenge with sort of the issuances that are out in the market is that they're often bundled in ways that use of proceeds isn't necessarily that clear, and they may carry a $5,000 denomination, which is great for some investors, but it doesn't deliver the level of access that we think needs to exist. So that's why we're really focusing on, with the deals that we are sort of senior manager on, showing a model for how this can work differently.
Fantastic, thank you. So let me try and unmute all. Please be mindful of that in case you're singing in the background while listening. And if you have a question and you are unmuted, feel free to chime in, and then I will re-mute everyone. Okay, you're unmuted on my end, and you might want to unmute yourselves if you're muted. Okay, looked like it was more background noise perhaps than questions. In that case, let me open it up again to Paul. If you had any final comments, anything that you'd like to wrap on based on what Mary and Rodrigo presented. And thank you again so much, Rodrigo and Mary, for presenting the work of Neighborly and your analysis of the CRA opportunity.
Thank you.
Yeah, this is Paul. I mean, what we find really inspiring about Neighborly is, as Mary alluded to, sort of unpacking this issuance document called the QSIP that is a lot of financial and contractual legal language, and very rarely is it focused on, and obviously it says what the use of funds is, which is sometimes pooled and ambiguous, and really helping bring some clarity, transparency, and standardization to it, so you can understand what you're doing. And what is powerful, and if you do want to see what a good QSIP looks like, you should definitely check out the DC Water Environmental Impact Bond, because it almost is kind of like an annual report, but it's also a plan for what they're going to do. And that's like one of the best, and but you know, looking like a pooled fund, that's, you know, sort of one of the most confusing. So what I think Neighborly brings is this ability. You saw, you know, 11,000 members, is for individual investors to invest $1,000 and maybe even $500 in their bond, to really community engagement. So when we were talking earlier, like, what do we do about Bellevue Health Center? It could be that patients maybe invest and families invest in that. It could be the community where it's located invest in it. From green power or clean power, the community can help fund, possibly through a muni bond, its own improvements. And so we not only can bring the metrics and accountability that we talked about in the first part of this conversation with the HIP ratings on 26,000 munis or even 6,000 corporates, with this citizen engagement system and really this power to vote with your money and to generate both, because munis of interest yield both income and impact. And if everybody's doing their job right on fundamental credit analysis, like the fund managers, and so we have an increasing number of fixed income managers that are doing impactful munis. And we helped create one of the first muni funds with S&W, is to really vote with your money, seek income and impact, and if we can all build a coalition together, we can actually get issuers to be more accountable to their mission, which is what they should be doing in the first place. So capital markets really provides this lever for accountability, especially as, you know, we worry about the trustworthiness and competence in our institutions. So that's what I think is really exciting in trying to achieve social justice and ethnic excellence and overall environmental justice, as well as what you've heard today are tools like ratings and platforms to bring focus, clarity, and accountability. And that if we vote with our money, the institution should follow. And if we proactively vote with our money, we can actually catapult people in the 21st century and help to self-actualize, as Maslow envisioned.
Great, thank you, Paul. And of course, not surprisingly, this lines up very well with a lot of the work that the Investor Network, the Transform Finance Investor Network, has been doing on two of the pieces. One is this notion of around what can we organize asset owners, right? What are the opportunities to engage in deeper ways? And secondly, as Paul just mentioned, picking up on Mary's earlier comments, really this idea of deepening the community's engagement, both the voice and the governance role that can be played over the way in which capital flows in and out of communities. So while things can be a little bit wonky and perhaps drier than most of the social enterprise stuff that people associate with impact investing, it seems like some terrific opportunities to really drive some of that impact. If there are no other questions, Here is a slide with the information, both for Paul at HIP Investors and for Mary and Rodrigo at Neighborly. I'm sure they would love to hear from you, or you should feel free to reach out to me as well, Andrea at transformfinance.org, and I'd be happy to put you in touch, or otherwise see how we can take a more active role in this space. And lastly, if you are interested in our activities overall as Transform Finance Investor Network, or if you are an investor that is interested in joining our community, also please feel free to reach out to me. My email is there, and I can be found at andrea@transformfinance.org. And for all the fantastic work that you all are doing at HIP Investor and at Neighborly. We're really delighted that you could be with us.
Thanks very much. Excited to help transform capital markets.
Let's do it. Thank you. Thank you, everyone, for joining us today. The meeting is now over.